Hi folks, welcome to a product review at Finominal. Today we're going to look at the Primark Meketa private equity investments funds that trades under the ticker PMPEX. Now this is a somewhat unusual fund compared to the mutual funds or ETFs we usually look at, given that this is an interval fund and it only provides liquidity on a quarterly basis. Now, the fund provides exposure to a medium-sized private company. So you can look at it like a private equity fund. And it aims to, well, offer the benefits of ownership without the stock market volatility, which is great if you can truly offer that. If you look at the fact sheet, we do see that most of those companies are medium-sized. They have a focus on recurring revenue and positive cash flow. And that effectively leads to a distribution by sectors where you have a large overweight in software companies because a lot of them are quite profitable and they have recurring cash flows. So you have a more than 50% allocated software companies. Given where AI is leading us at the moment, it should be quite interesting to see how this fund is performing, right? Because there's a lot of disruption happening. If we look at for a benchmark, we do see, we do actually see a benchmark here, which is the MSCI ACWI. And that's a little bit unusual because the MSCI ACWI provides exposure to primarily large cap companies, right? Not medium size, but we'll stick with that. We can look at the performance of PMPEX versus the MSCI ACWI since 2020. And what we do see is, well, we do see roughly the same trends, right? But also an underperformance, especially over the last 2 years. Now, one of the objectives of PMPEX is to provide lower volatility, and it does achieve that. Its volatility over the last 6 years was 9.4% versus 15.9% for the MSCI ACWI. We also see it had a significantly lower drawdown, but it didn't have a higher Sharpe ratio. And that's simply because the return is so much lower than what the ACWI provided. Partially, that's can be attributed to the strong performance of the MSCI ACWI, which is driven by the Magnificent Seven and similar stocks. But there's also, of course, the excessive fees. So PMPEX is charging 2% per annum, which is just ridiculously high. Now, there's no point in terms of looking at asset classes, economic sectors, even factor exposures, because the nature of private equity is that the private companies are being valued on a monthly, quarterly, or even less frequent basis by external appraisers like a Deloitte or PwC. And the valuations tend to be smoothened, which leads to this low volatility and also lagged. Now that, of course, also explains why if you would measure the correlation, right, of this fund to the stock market, you see it's only 0.33. Now, from that perspective, it does look like an uncorrelated fund. And on paper, it actually generated significant diversification benefits. So if you look at the Sharpe ratio of the S&P 500 over the last close to 6 years, it would have been 0.95. And if you would have allocated to PMPEX 25% allocation, that would have increased to 105. Now that's great, and that's of course exactly what the private equity industry is marketing itself on, providing uncorrelated returns. But if you think about it, what they're allocating to, it's companies. And if it's a private company or a public company, in a diversified portfolios, these get affected by the same drivers, which means like the economy, employment, interest rates, and it's effectively the same asset class. Even people tend to differentiate that from the perspective of the private equity managers, right? Now, we can show this quite nicely that if you would simply try to take the S&P 500, a 60% allocation, and a 40% allocation to cash, you would get something that looks almost identical to the performance of PMPEX. And this is basically the same amount of volatility. In fact, the replication portfolio, right, which only has 2 instruments, achieved a higher return and a high Sharpe ratio. Now, so that kind of highlights that PMPEX is offering not much more than just diluted equity. And we can also replicate in a different way, simply by using the tricks of the private equity industry. As mentioned, private companies value the value companies, right, on an irregular basis, right, and valuations are smooth and lagged and so on, and that leads to that nice return profile. Now we can simply take the MSCI API index and we can do an average over the last 3 months of the returns and effectively generate a similar smoothed profile. And this is exactly what we're seeing. So we have the performance of the Primark Meketa Private Equity Investments Fund, right, versus this smoothened MSCI API index. And what you can see, right, effectively, right, that the profiles are kind of very similar, well, except for the smoothened MSCI API index outperforming. We can see that the volatility of our smoothened index is actually now lower. Jordan is still slightly higher, but the Sharpe ratio is double that of PMPEX. And more interestingly, if we look at the correlations to the stock market, we do see that the correlation of PMPEX is 0.58 versus the correlation of our smoothened MSCI ARC index to the S&P 500 in this case is 0.48, so lower. So stated differently, you can create private equity returns yourself simply by playing around with the numbers that you're reporting to yourself and create something quite easily that has a low volatility, seems uncorrelated on paper. Problem, of course, is right, and that's the problem of the private equity industry. If you do need to sell an asset, let's say during a downturn, then you do need to then you do get a mark to market, right? Because potential buyers, right, they're going to look at what the multiples are in the stock markets, right? And they're going to price your asset accordingly, right? Then, of course, all that fake volatility and the fake valuations, right, they kind of like go away, and you do take that hit on your NAV. So this kind of concludes our short analysis of this fund from Primark Meketa. As mentioned, it is being marketed as something that offers ownership with low volatility, and on paper that is correct, right? But as soon as you start playing around with the numbers, right, you realize it's nothing more than just diluted equity with black valuations, and nothing special there, unfortunately. Private equity is still equity. Hope that helps. Have a nice day.